Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, one of my favorite guests and one of your favorite guests, too. I haven't had him on in a while. He was one of the first guests I had on and said, hey, this USA Watchdog thing's going to be successful. And I said, really? You think so? Oh, yeah. No, you'll be successful, really. Well, I'm talking about John Williams at shadowstats.com. John Williams, thank you for being really a loyal guest and somebody that comes on and speaks the truth to the public. But John Williams, shadowstats.com, economist. John Williams, thank you for being on USAWatchdog.com.
Thank you very much for having me, Greg.
I want to talk about gold last week. It's for the first time in months, it spiked up over $1,300 an ounce. Of course, it got beat back down, but still, their gold looks like it's catching a big. And I've had at least two people tell me that big money is starting to come into gold. Why is gold all of a sudden starting to shine again?
Well, gold is the ultimate hedge against all the craziness in the world and very bad financial markets, dangerous currency markets, bad inflation. Physical gold is that ultimate hedge. It retains its value over time, its purchasing power. You have circumstances where there's been a lot of central bank intervention in the past couple of years to knock the price down. It's been higher. I've been looking for it to go higher. It's going to go a lot higher as the circumstances here deteriorate. But the central banks like to see the price of gold low. And when it's high, it's an indication they're not doing their jobs. And believe me, the Fed is not doing its job here. We've got all sorts of problems ahead. And when you see flight like this, it's a flight to safety. But you don't know. I never look to play the gold in just the day in, day out. There are people who do that. I look at gold as the ultimate hedge to preserve the wealth and assets that one holds. Over time, over history, it's been the one consistent store of wealth, along with silver. But the precious metals have done that, and what it has several-fold. Number one, it's a store of wealth. It'll maintain the purchasing power of your currency. I was at a monetary conference once and giving a talk, and someone raised the question or moaned and groaned about how the price of front row center or second row center, whatever the ideal seat is in a movie theater, a Broadway theater in New York, that it cost a tremendous amount of money. And how his mother had complained that it only cost $5 when she used to go as a little girl. And I said, well, if she'd kept her $5 gold piece from then, and she could still get a prime seat on Broadway today for that $5 gold piece. It for millennia, it's retained its value, and not only is it a store of wealth. It's liquid, and it's portable. I mean, if you have to escape because of some kind of political or political violence or such, you can carry it with you. It's the ultimate store of wealth. So right now, what you're saying is that people are getting very nervous about basic safety of the U.S. markets, and I share the view.
Just so people know, a $5 gold piece is, a $20 gold piece is a little less than an ounce of gold. It's 0.967, I believe. So a $5 gold piece is a little less than a quarter of an ounce. So a quarter of an ounce, is, what is that? $400 and change, I guess. $425 and change or so, somewhere in that neighborhood. So yeah. Wow. But I want to move on to your alert that came out. Now, as you're talking about the, the shakiness of the, even though we're at all-time highs. We've had a couple of down days, but the shakiness of the markets, the economy, the geopolitical sphere, the politics going on, where they're trying to impeach a duly elected president on false charges, basically completely false lies. I mean, it's unbelievable as a journalist to see the people just lying and unchallenged lies. It's just unbelievable. But I mean, it just adds to the instability. And one of the things you came out with a week or so ago was an alert, which I thought, whoa, heads up. You don't hardly ever put out alerts. What tripped your trigger to say, okay, alert, warning, danger? What's tripping your trigger? What do you see that people should be aware of and warned of?
Well, there were several factors. Number one, I think we're at risk of an extreme market reaction just tied to the economy slowing down unexpectedly against headline expectations, uh, which is going to louse up the Federal Reserve's FOMC planning for raising rates and liquidating their balance sheet, which is going to force them back towards a quantitative easing. That in turn will savage the dollar. And with that, as the dollar plummets, so will U.S. stock prices. They're heavily supported by the influx of capital from abroad. And putting that aside for a minute, we're coming into what I call the squirrely season. And well, let me just explain that. Back in 1987, before the stock crash, I retained a mass psychologist to see if he could explain why you tended to have stock crashes in October and November. I mean, you could think of the 1929, for example, and generally the October November timeframe is rough for stocks. He came back with the explanation that humans have what he called a vestigial squirreling instinct. As the seasons begin to change, the squirrels go out and collect their acorns, save it for the winter. Humans do something of the same thing, only they tend to cut back some in their more aggressive investing, and they pull back. There's that squirreling instinct. Now, back in '87, I was looking for a crash in October, which did happen. I talked with one of my clients, big manufacturer, the treasurer there, and this was a week or so before the crash. And I explained that story to him, and he said, John, that's a week ago I would have said you were nuts. But last week I was looking to buy a car, and suddenly I just had a shift in sentiment. Figured, well, I'll put that off a little bit. And that's I've been getting calls from a number of my clients suggesting mounting nervousness, and given the combination of the squirrely season ahead of us, which usually comes after the end of September, but we're getting pretty close. And the underlying fundamentals in the markets and the economy, I think all the components are in place for one of the great financial panics of all time.
Well, let's go ahead and drill down on that just for a minute. Because I asked some other people the same question. You Shadowstats.com, you sell a newsletter to people to hedge. I know you can't give up your clients, and I'm not going to ask you to, but you sell newsletters to Fortune 500 companies, to big hedge funds, to people that manage billions of dollars. You are in demand. They fly you around the world. You go speak at conferences and things like that. Now, my question to you is the same one that I asked Von Griertz, and that is, what are your clients telling you, and is this something different than they've told you in past years?
Well, just as a point of clarification, I also have a number of clients who are individuals, small businessmen,
Yeah.
ranging from contractors, construction contractors, uh, people who have dry cleaning businesses, mom and pop shops. I get reactions from across a broad spectrum. And what you'll see is that there are regional differences in the country in terms of how business is doing. But most are not seeing very good times. And in fact, well, I'm out here in the San Francisco area. All of a sudden, this area that's been booming is beginning to see rents fall in the city of San Francisco. That's a very bad sign for what's happening out here. And this used to be one of the strongest local economies. You still have some strength up in the Seattle area, but generally you're beginning to see some slowdown. And
Is that a reflection of tech? Is falling rents a reflection of trouble in the tech market?
that's the way I read it.
Oh, really? And when you say we're set up for one of the biggest financial crashes in history, why do you say we're set up for one of the biggest financial crashes in history, and what will it look like?
Well, what you have right now is the stock market basically at an all-time high. I can't see any way of supporting that. Uh, but let me back up because there's been a lot of nonsense coming out of the Fed, and really this is a circumstance that we've never seen before. Because back in 2008, when you came to the brink of the banking system collapsing, that hasn't happened in modern times since we've been off the gold standard. I mean, you had a banking crisis back in 1933, which led to our going off the gold standard, so the government could do all sorts of things to stimulate the economy because it was constrained in terms of the money it could spend with the dollar backed by gold. But that in turn has led to the current circumstance where the dollar isn't backed by gold and the government's just spent willy nilly. But as the process went along, you had the Fed that encouraged all sorts of unstable debt expansion, all these very creative derivative instruments that helped to lead to the banking collapse. The system effectively failed back in 2008. I mean, we've never really had such a broad failure, effectively the system coming to an end as we know it. But rather than let that happen, and I can understand what they did, and I probably would have done the same thing in their circumstance, other than I would not have gotten us there to start with. Um, they did everything they could to keep the banking system afloat. They spent whatever money they had to spend. They guaranteed whatever they had to guarantee. They created whatever money they had to do. They bailed out corporations that were in trouble. I mean, look at the uh, automotive companies. The Fed bought AIG, the world's largest insurance company, to again prop up the markets, and they succeeded in preventing a collapse of the financial companies. Problem is, they didn't do anything to address the major problems that had led to the crisis. Very specifically, the federal budget deficit, which is right now is beyond any uh, containment as it's currently structured. That has to be addressed. But we're long-term insolvent here. Uh, we have unfunded liabilities, net present value, the amount of money you need in hand today to cover those obligations in excess of $100 trillion. We have an economy that is about $20 trillion. Never, we can't cover it. No way we possibly could. That has to be reorganized, brought into balance. And it was that problem which had led to dollar weakness, heavy selling of the dollar, and led to a number of the circumstances that brought us to the crisis in 2008. You have they didn't do anything to stimulate the economy. It was, I mean, there were a couple of things out of Congress, but nothing major. The economy really has not recovered. It is
So fast forward to today. The
yeah.
economy's not recovered, and you're saying we're set up for the biggest financial collapse in history. And you've painted we have not fixed what we had the last time. We spent a lot of money just to put it on life support. Why are you saying we are set up for the biggest financial crash in history coming up? Why is now not 2015 or 14 or 13 or 12? Why now?
Well, it could have hit earlier, but it's just gotten uh, more extreme as we've gone along. I just can't see it going much further. The Fed has kept the system afloat. What they've done um, has about run its limit. They had this quantitative easing to support the banks, provide the banks with liquidity. What they did was they bought treasuries and generally poor quality mortgage-backed securities that were impairing the bank's balance sheets. So they put cash into the banks. They didn't let the banks lend the money into the system. The banks had to deposit that cash back with the Fed as excess reserves, and the Fed paid them interest on that. So the banks were okay, but by not lending the money back into the system, it did nothing to stimulate the broad economy. The Fed's primary interest all along here has been to keep the banking system afloat. That's number one. Yes, they'd like to see the economy strong. A weak economy is not good for the banking system. Severe downturn in the economy can lead to banking system solvency issues, which they will always address. And that's what happened here. But a lot of the solvency issues came about because of excesses that they had allowed before. Now they're trying to get out of the quantitative easing. It's not a normal, healthy circumstance. The rest of the world's in trouble, but they've needed a strong dollar to keep the foreign capital in our markets. And that's, I mean, you have the foreign capital in our bond markets, and people generally are selling U.S. bonds outside the United States. They've drawn foreign investment into our stock market. Again, stock markets at or near an all-time high. And you add to that a strong dollar, it's a great investment for foreign investors. But if the dollar should collapse, which it's going to, and you'll see them pulling very quickly out of the stock market, because the stock market, even though it in dollar terms may still be high, is going to be dropping in terms of value for the foreign investor who's looking at his world denominated in something other than U.S. dollars. So the dollar declines, the foreign funds get withdrawn, and that brings down the stock prices. We had that happen in 1987. I mean, I can see a crash of the magnitude that you had back then.
25% and 22% in one day back then. So you're looking squarely at the dollar. You're looking at, okay, the Fed is in a bind. They got a huge bloated balance sheet. They can't dump it. They've got trouble on the way. If they do nothing, it'll totally crash and it'll take the banks down too. You're saying they're going to start with some sort of QE, and a dollar is going to take a nosedive into off a cliff with no water in the bottom of the pool. Is that what you're telling me?
Pretty close. I do see the dollar as being the proximal trigger. There are other issues behind that, such as economy not recovering, and in fact, it's beginning to turn down. And there's a fair amount of evidence in that. And that's what's going to trigger the Fed shifting its policy. We've already seen some hints of it in their latest minutes. They find the bank credits are not quite as good as they thought they were. They're saying inflation's too low, but they also know that the economy is not where it should be. So as the economy slows here in headline reporting, and you're going to see that increasingly in the months ahead, the financial markets are going to look more and more. Well, gee, the Fed's not going to raise rates again, and it's been the jawboning of raising rates, and now actually raising rates a couple of times, and then selling off these assets that they purchased during quantitative easing. That's what they're promising now. All of a sudden, they're going to stop raising rates, and they're going to back off liquidating those assets. And as the economy deteriorates and puts more financial stress on the banking system, they're going to go back. They've got to go back to quantitative easing. They can't let the banking system fail. And where that has propped the dollar and has been underlying the dollar at its current levels, you're going to see a plunge in the dollar. Fundamentally, the dollar's weakened over time because of our bad trade policies and our generally loose credit and monetary policies. Go back to 1987, and coming into that the crash in mid-October. You had a bad day on I think it was October 16th.
That's mid-October.
It was the Friday before the big crash. You were down something like 155 points. Big drop. Then over the weekend, nobody knew quite what was going to happen. The dollar had been weakening, and Alan Greenspan just came in as Fed chairman in September. He raised interest rates in August to prop the dollar. One of the big things you do if you're a central bank and you want to prop your currency, raise interest rates. That's what the Fed's trying to do. Then you had the big sell-off on Friday. Over the weekend, Treasury Secretary James Baker made the point that the U.S. is no longer going to support the dollar against the Deutsche Mark. Uh, that was one of the big issues there. Well, I knew from I cut my teeth here in trading currencies after Nixon floated the dollar, and that was a sure indicator you're going to have massive selling of stocks on Monday, and you did. There were other things, and often the people involved, and I'm sure they've learned better lessons, but we still had the circumstance in 2008. So they keep missing elements of the big picture here. They make certain assumptions. Well, this can't happen. We're not going to have another big crash in the economy again because we've got good control of it. That's what they thought in 2008.
And you're saying to get control of the situation, they made themselves incredibly weak, and now the system is much worse off, and they are much weaker than they were going into 2008. And you're saying that when the dollar starts tanking and the system starts tanking, it's all going to go down fast. Am I reading that right?
That's accurate. I mean, the issue here is that they did not take fundamental action to resolve the systemic insolvency issues. They went with stopgap measures, and that bought them time. But that's all it did. It bought them time, and we're about out of time because headline economy, is beginning to soften. It's a lot of indications of it turning down, and the Fed's going to have to again address the banking system.
If they don't announce QE, the dollar is not going to go up anyway, is it? I mean, the QE will just hasten the dollar's demise because that's what all these rate rises have been about. And they've been just really kind of protecting the dollar by sticking a toe in the water and raising a quarter of a point. That's all they're really doing. They're just trying to protect the purchasing power of the dollar. I mean, really,
that's basically what they're doing at this point. And they're but they've used the jawboning that we're going to raise rates. We're going to raise rates. Yes, we're going to raise rates later in another couple of months, and that helps to prop the dollar. They've used the jawboning to prop the dollar.
Oh, and you're saying we're about ending. People are going to go, really? We're going to raise rates? Yeah, show me.
Yeah. Well, that's the point here is that it's not the actual action they take; it's what the markets think they're going to do. And if the markets believe they're going to continue raising rates, okay, they'll buy that, and the dollar continues generally to stay reasonably strong. But when market sentiment shifts and they say, hey, the Fed's not going to be able to continue raising rates here. In fact, this is weakening enough that they're probably going to move back to quantitative easing. The Fed doesn't have to move to quantitative easing for the dollar to tank. You just have to have the markets beginning to shift in sentiment to that effect, and you'll see the dollar tank.
And Jim Rickards, who came out on this channel a while ago, and this story has surfaced again. And he said, Insider Jim Rickards, nice guy, 4-time best-selling author, nothing but respect for him. But he's saying that his sources say when this thing goes, they're going to freeze the system. They're going to boing, they're going to lock it down. We're going to have a bank holiday, unlike a lot like 33, I believe. FDR closed the banks and had a holiday. But he says it could be more than just a week or so. It could be weeks. It might be months. What do you make of that kind of pretty ominous prediction by an insider?
Well, anything like that's possible. The problem is that eventually the system has to be able to function. Yeah, any kind of a holiday, as they would call it, a suspension of financial services, whatever. You can't go on too long there. It becomes very disruptive to the system. But I mean, you have a crisis. Who knows what they're going to do? Putting a freeze on things to keep a panic from spreading really only intensifies the problem. What I do very simply, and you've got a terrible political situation right now in Washington. There are a number of factors that affect the dollar. Interest rates. That's a good factor anytime if you're looking to drive rates higher or lower, raise your domestic rates or lower them. that will have the effect in the currencies. That's primary manipulation tool for the central banks. But there are factors there beyond the control of the central bank. One is relative economic activity. I mean, the bank works on that, but if the economy is slowing or turning down, that's broadly negative. The big factor is political stability or perceived political stability. And right now, you've got a circumstance in Washington where tremendous political discord. I can't remember seeing anything like this in the past, where the incumbent president's been effectively had his option shut off in terms of moving the economy. He got elected. I mean, I was looking for him to get elected because of the weakness in the economy. Historically, that's a very good predictor of who's going to take office. So over time, there are different economic measures, but since the data have been available in the 1932, every time disposable income has been below a certain level, the incumbent party's always lost the White House. And guess what? They just revised the GDP numbers and disposable income numbers. The numbers, the way people were feeling them during the election year, were actually a lot worse than they'd reported before. I mean, they had them up shy of this is net of official inflation, little shy of 2%. They revised that down to something like 0.5%, and it's getting worse. This is not a happy circumstance.
And all the talks about Trump being impeached, you're saying adds to the financial instability of this fall, and I mean, some of his own senators are calling for radical change, quote unquote. I think it's Corker out of Tennessee. Radical change in the White House. What, to impeach him? His own party wants to get rid of him? I mean, for what? It's outrageous. But you're saying, ding, 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 look out, warning. This is a warning sign for a bad trouble for the economy, no matter who's doing it or why.
It intensifies the problems for the economy, but I can tell you right up front, it's a big negative for the dollar. I mean, you want to trigger dollar selling, a couple of things. Markets shift and they say, oh, we're going to see the Fed's going to back off its easing, and they're going to move towards quantitative. I mean, they're going to back off the rate hikes and they're going to move towards quantitative easing again. That'll tank the dollar. If you had a move towards impeachment of the president, that'll tank the dollar. It'd have the same effect. And in fact, some of the weakness you're seeing right now, I think, is due to the political discord. You need political stability, and there's a way things can be addressed here. I'll contend that Trump got elected because the electorate generally was dissatisfied with the way the economy was going. They wanted to see some improvement. That's not going to change by the next election. If anything, it's going to be worse. So we'll see what happens with the midterm election. But if the president had a cooperative Congress, and I've always found the American people will listen to things. You have someone who talks honestly to them, say, look, we've got a real problem here. We've got to get our house in order. People know we're not doing as well as the numbers show. Here's what we're going to do. And the first thing they've got to do is address the long-term solvency issues. The long-term, the U.S. is insolvent. Now, when you had the downgrade of the federal debt by Standard & Poor's back in 2009, that was at a time when there was, and we're still in the circumstance where long-term, the U.S. is insolvent. We cannot effectively pay our bills, at least not in terms of current value. We're looking at right now $100 trillion that's needed to cover our obligations, and there's just no way we can come up with that. Now, Alan Greenspan at the time said, "Oh, hey, don't worry. U.S. can never default because its obligations are in dollars, and since its obligations in dollars, all the U.S. has to do is print the dollars, and it'll just print the dollars and pay off the debt." Well, that's what gives you hyperinflation. And I've been talking about hyperinflation for a long time. That's still ultimately where we're going here, unless they can bring the long-term solvency issues under control. It's a matter of how you get there. But just paying off your debts with a dollar that you print, that guarantees hyperinflation. And what the Fed did and the in the panic of 2008, introducing quantitative easing was effectively monetization. It was a little movement in that direction. The Fed today still holds $2.5 trillion worth of treasuries, about $5 trillion when we add in the mortgage-backed securities, and although the Treasury pays its interest to the Fed on those holdings, the Fed remits the interest payments back to the Treasury. They've effectively monetized $2.5 trillion worth of debt. Now they're talking about liquidating it. I don't think that's ever going to happen. But here's, I'm sorry.
Go ahead. Here's what. Go ahead. Continue your thought. Sorry.
Okay. Well, let me.
Here's what. They're not going to ever liquidate their debt. I'm sorry, I interrupted you. So they're.
No, that's well. In terms of what the president needs to do is address the American people. Say, look, we need to bring the long-term solvency issue of the United States under control, and here's how we do it. And there are going to be some unpopular issues there, ranging from an overhaul of Medicare and Social Security, but again, the system has to be brought into balance. It can be done. Once that's addressed, then you can go ahead and increase the federal spending to stimulate activity, infrastructure, whatever. And you can widen the short-term budget deficit, because if you can come up with a credible long-term package for bringing the U.S. solvency in line, stabilizing the long-term circumstance, the financial markets will give you some leeway to widen the deficit temporarily to get the system, to get the economy rolling again. That's what they've got to do, but you can't do that in this current political environment.
Which brings us to the debt ceiling. Everybody thinks it's a lock, but even I think Ray Dalio is like, well, that's a problem. I don't know if they're going to get that raised. If they don't raise the debt ceiling, I mean, could we just have this is another dollar sell-off? Even if we don't, it's a weird, it's an oxymoron. If you don't raise your debt ceiling, the dollar will go down. If you do, the dollar will stay stable. If you don't raise the debt ceiling, could the dollar that's another pitfall for the dollar this fall? I mean, they got to raise the debt ceiling in September, right? So if they don't raise the debt ceiling, that's another tripwire for the dollar.
Well, it is if it means any kind of a short-term default, and that's what caused the downgrade in 2009. It wasn't that it was the downgrade was not based on the long-term solvency issues. Those ratings have to do with the risk of default in the next year. So when you have people in Congress threatening default, all of a sudden the risk is no longer zero. And as the risk rises off zero, that doesn't give you a AAA rating. So that's why you got the downgrade. So if there were threats of default, which may still come up here, you could see another downgrade of the dollar, which will tank the dollar. It's the long-term system has to be brought under control, or you're going to have a dollar panic that will eventually take the dollar to zero. That's, I mean, it's just a matter of time.
Yeah, I'm just giving your gut here in closing. I mean, I'm hearing that you're putting out these warnings, but you rarely do. You're not a Chicken Little guy that, the sky is falling. You're a real numbers guy. If you want to know the real number, the real unemployment, which is what you have, 22%. The real inflation, 7-8%. If you want the real numbers, the real facts, the real figures, which is why you're so much in demand with individuals and companies and hedge funds, what is your gut telling you about this fall? Just your gut feeling. Not your numbers, not all this facts and figures, just John Williams' gut. What do you feel this fall?
I would be out of the stock market. I'd have my money in gold. And I'm talking physical gold. Physically owning the gold, you can have very difficult times here, very unsettled political circumstances. You mentioned a banking holiday, something like that. I'm not saying that's going to happen, but when you get into a real panic here, almost anything can happen. And if you own the physical gold, you have the safety of the physical possession. It's portable, it's liquid, and it will retain its purchasing power against bad inflation, which eventually is down the road here if the government does not address its long-term solvency issues.
John Williams, you are an economist, the economist and founder of shadowstats.com. John, well, the links will be in the after the interview section for John Williams. I guess before I sign off, I guess having some cash short term, which will work really well. I guess you'd have some cash, some food, some supplies, things
Oh
like
yeah,
that. If the system goes down, the whole thing is run on credit.
you you want to have some cash. You want to have some physical gold. But most
Silver, I
important,
guess.
you need to be able to cover yourself for a couple of months with food. Suppose suppose the things that I'm looking for here begin to break. You may see rioting in the street. You may see disruptions in the supply chains to grocery stores. You don't want to start going out and fighting for food. You want to have a store of water, food that will keep you and your family alive and well. Let the difficult times settle down. You can if you can ride them out, and just play it safe. And guess what? You go out and buy canned goods today. That's a better investment than a treasury bill. You know why?
Why?
Because a treasury bill is not yielding more than inflation. So you get negative return after inflation adjustment on a treasury bill, but you go out and buy your canned goods, they go up in value. They'll be worth more next year than they are today. So there you get better return on your canned goods, buying your canned goods in a treasury bill.
And it's cheap insurance. If the worst doesn't happen, you can just eat the stuff.
Look,
Anyway, listen, John Williams, you're the man. I just love I love it when I'm having you on. Other people like it. I have this old saying, and that is, you know the truth when you hear it. And I sit there and listen to you and you go, that sounds like the truth. That sounds like the truth too. Anyway. John Williams, the founder and the economist at shadowstats.com for the real facts and figures and numbers. John Williams at shadowstats.com. Thanks for joining us today on USAWatchdog.com.
Again, thank you so much for having me, Greg.